and we'll go ahead and get started. So, first of all, glad to have you back, Dad and Adam. So we missed you guys last
Yes.
week. So,
Yeah. Well
any
rested up.
yes, hopefully you guys
Or
all had a good week too. All right. Uh, okay, we're gonna go ahead and kick it off. Okay, so most everybody that's on here has Penn Mutual policies. There's a few that have maybe like MTL or Guardian or Mass Mutual, and so we'll try to cover this on a couple different levels with multiple different carriers. But we get a lot of questions when you guys get your policy anniversary statements and you get your upcoming, you know, contact stuff, and some of you have questions on that, so we figured that we would touch on that today and go over dashboards. So again, that's why it's not going to make any sense to you if you do not have a policy to be on here, because it won't pertain to you. But um, we're going to cover some things that are on the dashboards. Number one, how to find them, what's on there, how to interpret it, and so we're going to try to go through kind of a deep dive on that. Because we do have majority of you that are on Penn Mutual policies, we will spend probably majority of the time on that. And Adam, if you don't mind, I know that there's a couple of Guardian ones too. I don't know if you're comfortable maybe
yeah.
sharing. I used to have a Guardian policy and I don't anymore, or I would share my own, but I know I just put you on the spot and asked you to share your
Oh,
personal
that's fine. Yeah, I
information.
can
But
I can bring mine up.
if you don't
Yeah.
mind doing that, that would be great.
Yeah.
And I'm trying to look at the names that are on here. If we have anybody else that pops on that has a different carrier, then we'll cover that. Otherwise, we'll probably just cover Penn Mutual and Guardian, since I think that everybody that's on here has those two policies. If you do happen to have a different policy with a different carrier and you're on here and it's not Penn Mutual or Guardian, can you actually send one of us as a host a note so that we know and we can cover that for you, so
Put
that we're
that in the
not keeping
chat
you
if you
on?
would.
Yeah, just send a chat. So
Okay.
okay. All right. So first and foremost, one of the things that we want to touch on and just kind of reiterate is that when you get a policy statement, you should be receiving that somewhere between 30 to 60 days before your policy anniversary date. So it's never a calendar date, it's always an anniversary policy anniversary date. Sometimes if you've had your policy be backdated, then it would be 6 months and 1 day before your birthday. So that sometimes makes it easy to remember that if your policy was backdated. If you look at your birthday, mine's February 15th, so my policy anniversary date would be mid-September, usually September 14th, for example. So that's sometimes an easy way to remember it. Now, you have several different things that you can do, update, change, rearrange when you have policy anniversary dates that are coming up. Now, I know that with Penn Mutual and with Guardian, I believe it's the same way, that you can actually opt to do paperless on your statements. Now, here's my one word of caution on if you go the paperless route. If you go paperless and they're emailing it to you and you're not good about checking your email, make sure you're paying close attention to that. For that reason, I purposefully like to not do paperless so that I get that in the mail, so that
Yeah.
I have it
hmm
physically to look at, and then I make sure that I'm kind of paying attention to it. So just so that you know, that usually will get sent out to you somewhere between 30 and 60 days before your policy anniversary date. And so that way you can kind of keep an eye out for it. You may want to go in and change your option if you want to opt out of the paperless, so that that way you do receive the paper statement that comes to you, or just know to kind of have that on your radar or put it in your calendar or something. Um, Something else to note is that every single one of you on your policies, you have the what we always kind of refer to as the minimum premium and then the maximum premium on what you can put into your policy. So even though it's not a required amount for you to put in toward the additional premium or the paid up addition premium, if you are only putting in the minimum every single year, you want to be careful that you understand that your cash value is not going to grow the same as the illustration that you were looking at if you're only putting in the minimum. So the illustration that you saw was probably with you putting in the maximum or some version of the maximum, either one. And so the more that you feed it, the faster it's going to grow that cash value. So it will still continue to grow cash value, even if you're just putting in the minimum. Not all of the paid up edition, I mean, not all of your cash value is going to come from that paid up edition premium portion, but a good amount of it is. And so understand that if you're wondering about, like, hey, this doesn't seem like it's growing as well, if you are only putting in the minimum, it is not going to grow as well, because it's covering both the death benefit and then giving you some cash value. And so it's going to be a proportion of that. Um, the the minimum would need to be put in, and you can also change up how you put that in. So you can do your premium annually, which they're going to give you a discount no matter what carrier you're with. These are some kind of blanket statements. So no matter what carrier you're with, you can put in annually and they'll give you a discount. You can also do it semi-annually, which is twice a year, quarterly, or monthly, and so they'll do any version of that that you want to. You can also do payment on the premium for the paid up edition on a separate type of thing. Like you could say, okay, I want my base premium or like my minimum premium to be on a monthly set scheduled setup, and then I want to put in my paid up edition anytime I want to throughout the year. You can do it that way. They don't have to be on the same schedule. You can pay those differently from each other. So there's some flexibility in that. So if you are wanting to make changes to how you put into your premiums and policy, then just know that the time to make those changes is usually like right before your policy anniversary date. So any changes you want to make, that's a good time to do that. Um, the Sorry, I'm looking at some of these posts really quick. Um,
Yeah, I'd say in most cases, having the PUAs on like an unscheduled thing is probably the best case scenario. That way, you know, you're never getting a bill for it, and you can just randomly put it in at your discretion. I know
mhm.
that can be different from company to company. I think with Penn, if you're on a monthly schedule for your minimum, if you want to add paid up additions, I think you have to call. You can't just do it on your dashboard if you're on monthly. If you're on quarterly, I think you can though, right, Christy?
Right. Yeah, if
Okay.
you're on quarterly, semi-annual, or annual, then you have the dashboard option for your paid
Yeah.
up edition. So if you do your minimum premium or your base part of your premium, if you're doing that monthly, then if you're wanting to put into paid up edition anything other than upfront, it becomes a little more tedious to do that. You're either going to make a phone call and do a payment over the phone for that paid up edition amount, or you're going to do like an automatic bill pay, like through, which I know sounds super old school, but I used to do it through my like bill pay through my bank. And so I would
Mm.
set up an automatic payment and you can have it send out like I don't even know what they call it now, but like a bill pay kind of thing where you can set it up on a schedule or you can just do like a one-time amount. You can do that through your bank. You'll just want to make sure that you put your policy number and put, paid up edition in there so that they know how to apply it. If you put an amount in there and you don't put that it's for paid up edition and you have a loan out, then they're not going to know how to apply it necessarily. They usually will make the assumption of putting it in toward new premium, but if you're wanting it to be classified as like a loan repayment or you want it to go in toward paid up edition, you'll just want to make sure and classify that on there. And I would still say that I would just look on your dashboard, afterward to just make sure that it got applied correctly so that way you know, you're not surprised by something later on. And if you go on your dashboard and you find out that, hey, I meant to make that as a loan payment and I accidentally classified it, you can call them and say, hey, that payment that I see on my dashboard, can you reclassify that and switch that over? And so you can't do that like years later, but if you catch it right away, then that's something that you can just have them reclassify it. So yeah. Um, the paid up edition part of your premium is totally flexible, so you don't need to put anything toward that. You can put in up to the amount that it'll show on there, and so that's kind of your upper limit of the amount that you can put toward there, so that should be helpful. You can also see that on your dashboard, and I believe you can see that with Guardian as well, right, Adam? Like on how much you can
Yes.
put in toward paid
Yeah,
up.
it'll always show you how much room you have left for the year.
Mm-hmm.
Gives you that amount. Yeah.
Okay, now keep in mind that paid up editions, if you want to receive the dividend for the whole year, you're only going to be earning dividend once it actually hits your account. And so if you're putting in your paid up edition and you're dividing it up over 12 months, let's say, then you're going to be earning full dividend on a 12th of it and then, 11 months worth on 2 months of it. Does that make sense? And so if you're trying to earn the most on dividend, then ideally you would want to put into your policy and pay your premium annually so that way you're receiving the full year's dividend. So just something to keep in mind. So, but it's also a little bit budget driven. So if you've got a tight budget and you don't have the ability to do it annually, don't stress about it. Just put it in when you can put it in. And if you end up missing out on a little bit of the dividend, it's not the end of the world. It's important to try to put in what you can put in for your policy year, but don't stress yourself out and feel like that it's worth it to like be over leveraging yourself in order to just try to get it in there to get the dividend. It's okay. It will earn what it earns, and don't stress your budget out overly by doing that.
So I was talking to Shane.
What's that?
I was talking to Shane about putting all my paid up additions. My policy just starts in September. And I was just going to make my whole year's paid up addition in, and then I'll just have to make my premium payments quarterly. So instead of quarterly, I can do that. I can put all my paid up additions in, and then just pay the premium as when it's due quarterly. Correct?
Yep. Yep. So yeah, if you yeah, the paid up addition portion, especially the first few years of your policy, is going to be where all of your cash value is probably going to come from the whatever you put in toward paid up addition on the first year, and then slowly you'll start having some coming from that base part of the policy. But yes, ideally you would want to do that either quarterly, semi-annually, or annually for the base, and then the paid up addition you would do upfront at the very beginning of your policy year in order to get the most out of the dividend. That's how you would want that set up. Yes.
Okay.
Question
Perfect.
for
Thank
you.
you.
Yep.
If is there any fail-safe, let's say, I know you said in the dashboard it tells you how much you have for the paid up edition. If you fat fingered or something, is there something in there to stop you? Or if you're trying to, will they tell you, hey, that's too much?
Yes. Yes, yeah, which I have done before, and it kind of panicked me a little bit. My dad's like, "It's okay. Remember they give you a time frame to correct it." I'm like, "Oh, oh, good." Okay, so yes, if you so like this one that's up on the screen, I'm not sure who's sharing that screen. Is that you, Adam?
It's me.
Oh, Dad. Okay. So this is one of the pages of your document if you have a Penn Mutual policy. And so if you see that top section right there that's in that kind of top block, see where it says like annual premium, and then it says 8,444 and 63 cents. So if you do it annually, they're going to give you a discount, and so that's the discounted annual amount. Now, if you did it semi-annually, quarterly, or monthly, so every single one of you that has a Penn Mutual policy, you have a page in your illustration that looks like this, and it'll be somewhere between page like 11 and 17, depending on which illustration version you have and the pages that came before this, but it'll be somewhere right in that section. Now, if you're doing it monthly, see how it has 734.68, but then if you took that number and multiplied it by 12, that's actually 8,816.16. That kind of shows you what that discounted amount is, doing it annually versus doing it monthly. So they charge you a little bit more when you're doing it monthly, or another way to say it is they're going to give you a discount if you pay it annually. So if you're doing quarterly or semi-annually or annually, then with Penn Mutual, you have the option on your dashboard to see how much you can put in toward your paid up edition. You can make it straight from your dashboard. So that
Could you zoom
21,000.
that page a little, please?
Yeah, Dad, can you make that a little bigger? Like just hit like Control plus, or go up to the, yeah, there you go.
Thank you. Now, by the way,
Or scroll down just a tad. There you go.
if you want to get creative and you wanted to remember, Christy just said a minute ago that the paid up additions right here is where the most of the cash value in the early years is coming from. Is there any reason why you couldn't do this on a monthly basis and put 734 monthly and then drop this in at the same time? So in other words, you're coming up with 21,000 or 22,000, whatever. In other words, add the 21 plus the 734. Couldn't you do that?
Wait, I don't understand. I didn't follow you on that. What do you mean?
Couldn't I do this on a monthly basis? But I'm telling this that this is going to be done annually, but I can put this in anytime I want. So couldn't I do the 21,000 plus 734 all at once? And wouldn't that give me more cash value in the policy? Say yes.
So what we're saying is at the beginning of the policy year, if you're putting in that monthly for the base and then putting in the 21,000 for the paid up edition at the beginning of the year, that's another way to maximize that. on how much you have available and earning dividend in the first few years especially.
Okay, I'm still a little unclear. I think if I say it out loud, you mean that you're paying your paid up addition annually and then the policy, the minimum amount monthly. Is that what you're saying?
Exactly. They don't have to be the same, is what I'm trying to say. They don't have to be the same schedule, if you will.
Mhm.
Okay. And then that'll save you also a little bit on that monthly, or you give you a little bit of a discount because you're paying the biggest amount up front.
No, no. See, I could put $21,000 and pay 8,444 of the premium. And then the balance I could do anytime I wanted to. I'm just saying that you have the flexibility to do what you want.
Okay, I think I'm
Does that
confused.
make sense?
I'm not clear. It's okay. I can watch this again.
So I can put in 734 each month. And in the second month, I win the lottery. Couldn't I pay the 21,557 in the second month? Say yes. I can
Okay,
pay it I can pay it anytime I want to.
Is the 734 a paid up edition?
No, this is the premium.
Okay, let's.
Oh, okay, month. Okay, the screen was cut
Okay,
off.
good. Yeah, that's what it was. I couldn't see that, but I'm also
Right.
looking at my policy over here on my other screen. So
Okay,
Yeah.
so you have the flexibility of having two different schedules. One is how you pay we consider this to be the base, okay? This is what the insurance company is expecting to come in.
mhm.
They don't care if you put this in or not. We do.
Put what
We
in
as policy-
specifically, Jim?
We as
The paid up
policyholders
edition.
want to put into
Oh,
paid up
okay.
addition.
Okay. Okay.
The insurance company doesn't require it. The only thing they're going to require is all they're going to ask you, like if you called them on the phone and you have a policy anniversary date and you're like, hey, I want to change my premium mode, they're going to assume that all you're talking about is that base part, that top part, because that's the only part that they care about. So
The premium, you mean?
yeah,
Yes.
that minimum premium, that's the only part that they're caring about. So they're going to set you up on whatever premium mode you want for that. And then on the paid up edition, they're not even going to ask you how you want to pay that because they don't really care if you put it in or not. So you want to put it in as early as you can put it in, but you want, like kind of to my dad's point, if you know that, hey, I've got a bonus coming next month, but my policy anniversary is this month, then feel free to just wait till the next month and then just put it in. So,
But you have to differentiate when you're making that payment that you're putting it paid up addition, or the amount will tell them that that's what you're doing.
yeah, actually, I'll show you that in a second on what that looks like. I'm actually going to pull up my dashboard with Penn Mutual, and so we'll go through a little bit of like a dashboard review on that too, and where you kind of find some of those things.
So basically, before I leave this, I just want you to know there's options here, and you don't have to remember all this. Call us and say, hey, I'd like to see, this is $30,000 is what I'm putting in. I'm putting in 88 plus 21, and if you add those together, it comes pretty close to $30,000. And that's what this guy was planning on doing, but life gets in the way.
Oh,
Life gets in the way, or you want to make a change, or there's more money coming in later on. I can mix and match these is what I'm trying to tell you. That's what I want you to know.
Okay.
Okay?
that's for Penn Mutual.
Yes, but it's the same thing with
it's going to
Guardian.
be the same with Guardian or MTL or Mass or anyone else that you might be with.
So Guardian would call this, if I told the insurance company, charge me $30,000 a year, Guardian calls that your what do they call it? They call it they want it scheduled. So I've scheduled them to bill me for that, but I get to decide whether I want to pay this or not.
Okay.
So Guardian will schedule that together, or they'll just schedule the 734, or they'll just schedule the 844. And you can change that every year, but you need to change it before your anniversary. Don't wait till the day
Okay.
before. You just have to so call us and say, hey, I got some changes coming out. Let's talk about it. So that's all I'm saying. Okay.
Okay. Okay, good.
Okay, Christy, back to you.
Okay, now at the same time, actually, can you bring up your screen one last second? Just one other thing to clarify on that.
Sure.
If you are doing your base premium on a schedule with them, in other words, they're drafting it out like monthly or quarterly or however you have that set up, if you have that scheduled with them, if you want them to also schedule that paid up edition part for you, while you're at it. Like, let's say you're like, you know what, I want to do $1,000 a month scheduled, and then the rest of the paid up edition, I want to just drop it in when I get a bonus or when I get excess. You can also do it that way. Now, they're not going to charge you extra to do that paid up edition on a schedule because they're already going to be drafting that minimum part for you. So in this example, if you got that 734.68 that you're doing monthly, and then you say, you know what, I want you to also take another 200 and whatever that is. I can't do the math on the spot. Where's
66.
Walter? Anyway, so if you want to take that difference, then you can tell them what amount you want them to schedule, and they will also do that paid up edition on a schedule for you as well. And they won't charge you for it. So even though they charge you extra to do the base on a monthly, on the paid up edition, they're already going to be drafting. And so if you want them to add an extra amount and call that paid up edition, then you can also do that. So
But
if you say, hey, I want that to be $200 or I want that to be $500, you can have them just do that at the same time, and then you can have that be scheduled if you want.
And just remember, you get to decide all of this, which is, I mean, people will tell that a whole life is not flexible. It is very flexible.
Yeah.
Okay?
Well, actually, because traditional whole life is not flexible. It's one amount. The way we set it up, you've got, your whole life part, you've got your term insurance rider that goes along with it, and those two together are those minimum amounts, regardless of what carrier you're with. The paid up edition part is the part that's flexible, and so that's where your flexibility lies.
And one other thing before we leave it, the maximum you can put into this particular contract is 21,555.37. Okay, that is the maximum, which is the same as this right here. But they have something right here that kind of freaks you out if you're not reading this carefully. It says PUA rider payment requirement. Don't let that spook you. What that's saying is if you're not putting in at least half of this total amount that you were planning on, if you weren't doing that over a 5-year rolling period, they're going to say, you know what? They don't want the paid up additions rider anymore, and they can pull it back.
They can
Okay.
take it off as an option.
I can take it off. So that's why they call it a paid up additions requirement. And you'll see that with Christy in the dashboard here in just a second.
Yep.
Can that be reinstated later?
No.
No.
Oh, okay.
Well, the answer is yes. If you go through underwriting again, maybe.
Okay.
But it's not guaranteed that they're going to give it back.
Correct.
Mean a new health exam and everything else, you mean?
Yes, basically, yes.
Okay.
So for all intents and purposes, don't let it lapse. And they don't have to give it to you. So if you let it lapse, it's gone.
Yep.
So one last thing on this. We want you to get, put the money in the policy to get credit for it, quote unquote. What do I mean by that? That $21,000, if you don't have it in the policy, it's not earning anything.
Mhm.
So you have to put it in the policy, put it in the policy, even if you have to turn around maybe sometimes and borrow it back out again. But you want to get credit for it because what that's going to do is it's going to increase your cash value, and you want to do that.
That is helpful. We can take a loan and then put it back in there later.
Yes.
Yeah. Now
yes.
you guys be careful with that. So with that, I have done this before where I've said, okay, now you only want to take out a loan for what you know you can put back, right? So don't just be taking out a loan just to put it in for, like don't be putting in more than what you think that you realistically can put in. But there's been times where I had a policy anniversary date coming up where I'm like, you know what? I'm actually going to borrow from my policy to put in that paid up edition up front. And then I'm just going to go back in and pay back my policy loan throughout the year as I'm able to. Okay. Now that becomes a dangerous game if you're doing that just to put that amount in. So don't misunderstand me on saying that. When I do that, if I'm putting in, like in that example, the 22,000 toward paid up edition, if I'm like, you know what, I know that I could put that in over the next 3 months or 5 months or 6 months, I'm going to go ahead and just take out a policy loan, and then I'm going to put that in as paid up edition, and then I'm going to go on my dashboard and then just pay back my policy loan whenever I feel like it. So that is something that makes sense to do, because then now I'm earning dividend on it, even though I have a loan out against it. I'm still earning most of the dividend, and then I can go in, and it's more of like a mechanics and a simplicity thing for me to go in and just make a payment toward my loan whenever I have a lump sum that I want to chunk toward it. But if I'm not confident that I can pay back that policy loan, I'm not going to do that because it doesn't make sense. I don't want you to be borrowing from your policy to be stealing from it. I want you to be borrowing from it and be smart financially. And so there's a difference in strategy with that, and hopefully that's clear on saying that. So there are groups out there that will tout that, hey, over leverage your policy and take it out just to pay the policy, and it's like, no. Like, use it to your advantage and to your system, but don't abuse the system because you still have the policy and you still have the loan out and you want to be able to replenish it in a decent time frame, or at least have some game plan to replenish it. Don't just put it in there and borrow from it just to be borrowing from it. So
And this is a good example right here of what she's talking about, because quite frankly, this is over leverage. Seriously. Can you see that? He's put in 3 times $30,000 times 6 is $180,000, and the loan balance is 173. So most of the money has been borrowed against this.
Oh.
policy.
Not seeing where oh, the premium amount is 30,000.
There's the premium amount right here.
Okay, I was looking at the highlighted. Okay.
Okay. So what's happened is this is seriously over leveraged. Now this is a policy that is basically using the Rockefeller method. So there's other issues going on here, but if it wasn't for that, this would be seriously overloaned. Because what happens if they can't do that $30,000 this next year?
Yeah, that's the problem. If you can keep max funding it, you can make it work. But if you're not max funding it or paying that loan down,
yeah,
that's
if
a
you're
no-brainer.
over leveraged and you're doing the minimum, you're going to start to jeopardize
Yep.
wiping out your policy and having
Right.
it lapse because it's not able to sustain itself because you've
They-
got more
This
drag than momentum.
person buy a house with a loan? Looks kind of like it.
And it could be. I mean, there are cases where this might make sense, but just understand that, you want to be careful that you're not over leveraging, that you have like your finances as a whole. It might make sense to do this if you're looking at the whole big picture. But if you are in a tight financial situation, like if this was your policy and you were tight in all your other financial assets and cash flow and everything else, it would not make sense for you to say, oh, I want to take a policy loan and put in that 30,000. Nope, we got to stop the bleeding first and, put in what you can put in, start making some headway on paying back the loan. And so it depends, but you're right. Like if that was a policy loan because you paid off a house mortgage that was at 9% and you're actively replenishing and paying that back, that's a very different situation than if you're like just letting that ride and you're not paying any interest or doing anything on it. So there's different situations going on. And if you're not really sure with your particular situation, schedule a consultation with us and we'll go through a strategy session with you to help you figure that out. So if you get to your policy anniversary and you're not really sure where it's going to come from or how much you should put in, let us go through that with you so that we can do your annual review and help you come up with a game plan from there. So
I have a quick question.
Mhm.
Back to Jim's point. Are you saying if you don't max out your premiums, then they'll pull the underwriter, or are you saying if you don't max out your PUAs?
Well, what we're really saying is if you don't feed the policy, so this is a good time to talk about this. When we talk about feeding the policy, we're putting money into the policy. How does it get there? You can see right here, I can put in, no, this is base premium and PUA, the 30,000, but I've got a loan of 173. Now think like a banker. Is that an asset or a liability right there? Think carefully.
Liability.
An asset. I know this one
Okay, is it an asset? Why is it an asset?
because you can gain. It's a gain. I
Okay,
mean,
the banker has a loan. You owe the banker $173,000. To the banker, that's an asset.
because
Think
they call you on that note, and as a bank, they can call it, right?
they could call it.
It's an asset by the fact of the interest it's going to generate.
Correct. What if we pay this off? What's it going to do to all these other numbers?
It'll create dividend,
Well, it's already got dividends.
right? Okay. Oh, that's true. That's true. Well, yeah, simultaneously, that's right.
It will increase the death benefit.
Okay, can you write these numbers down real quick, you guys? 173, 179, 189. And then write 987,
Just
1045, 1100,
take a
1153.
picture of it.
You can take a picture of it if you want.
There you go. She can keep it.
Okay, now I'm gonna come back in just a second. I'm gonna pay off the loan. So this is a real case, so I don't want you to see who it is. Okay, so I'm gonna pay off this loan. Sorry, Christy.
Pay my loan off too.
So
Yeah.
I'm going to repay this loan, and I don't know how much the loan is going to be, so I'm just going to put a number in here. And I'm going to do that. What year are we in? We're in the 6th year. I'm going to try to do it in the 6th year. Okay, let's see if that'll work real quick.
Now, one thing I want to have you do, Dad, after this is show that loan not getting paid.
Yeah, this is the loan not getting paid.
Okay.
I want to pay it in the 7th year. This is the 7th year I want to do it. Sorry.
Because the policy is in its 6th year right now, I think it's.
Yeah, so I got to do this instead, Christy. I'm sorry.
No, you're good. Now, while he's doing that, there was a case that came up, or a situation that came up this week with a client that we were talking to, and anyway, one of the things that he was asking is, he said, "So, do I want to pay back that loan, or should I not?" And I said, it really is up to you. The more of it that you are able to put back, the more it's going to give you in increasing your cash value, and then it's just going to give you that much more in tax-free retirement income. And so in his case, he was like, okay, well, I didn't really think about it that way. So I'm going to try to explain something and hopefully give you kind of a parallel to help this sink in a little bit. So when you're taking money from the policy and you're using it, like let's say you take out a loan and you're using it for an investment property, right? Now you want to basically say, okay, if I didn't have that money in my policy, where would that money have come from for that X, Y, and Z that I just did? And how much would I have had to pay for that? So when we talk about being an honest banker, that's what we're referring to. We're saying that wherever that money would have come from or taken out of, treat your own money with that same respect and put it back at a similar rate or a similar payment or a similar, however you want to classify that. Now, what that's going to do is it's going to just increase your credit line again. So think of your policy as your life insurance line of credit. It's no different than a house HELOC, right? A home equity line of credit. So on a home, so if you have a loan against your house, right? Whose money are you borrowing to access the equity in your house? The bank. But isn't it your money? Okay, it's your equity, but you're using the bank's money to access your equity. It's no different than with a life insurance policy. So sometimes that helps to make it clear. So the faster that you put back the loan and pay back the loan, the more equity you give yourself. Okay, now you're not only giving yourself equity because the cash value is going up, but every time that you put in money, whether it is new premium, like let's say paid up addition, or you're paying back a loan, it's having the same net effect, which is to increase the cash value and to increase the death benefit. So the question becomes, do I want to pay back that loan? Absolutely you want to, because I don't know anyone who's like, no thanks, I don't want it to have tax-free income in retirement, so if you don't want as much, then that's okay. So if you want to take that money and you want to pay off your house because you care more about having equity in your house, I mean, more power to you. You could do that, but why would you want to when you can, if you have the financial ability to then put that money back, then you can give yourself tax-free income and have equity in the house. And so that's kind of where that comes in. So hopefully that helps. So even though it's not a requirement, it's in your best interest to put it back, but you get to pick how fast or slow you want to, and that's probably the better part to try to decide.
Okay, so here's the loan of $173,000, and there's my cash value, 6350. But look what happens when I pay this back. Now I'm still planning on doing the 30,000 here. And so if I add 30,000 to 173, what do I get? 203. So I'm paying back 203. So I've repaid the loan. And what does that do to my cash value? Look at that.
You're bringing it
Yeah.
up.
And look at what it's doing to my death benefit. So do I want this in retirement?
Yeah.
I don't need death benefit anymore in retirement, but maybe you want death benefit to be able to give you more money to spend.
Well, cash value is something workable now.
Yes,
Mhm.
exactly. So I pay this back. So here's my scenario. I've got a house that a property that I put 173,000 in, and I've had it for X number of years now. I want to pay it off because I'm going to sell the property, and I need some place to put this money, so I don't want to pay taxes on it. So I put that money back in here.
Mhm.
Cash value pops back up to 218,720 of tax-free money. And see what might change it. I mean, see what's happening.
Mm-hmm.
Yeah.
And you can only borrow what the total net cash value is at any one time, right? So this person now can only borrow 6350. Not that he'd want to, or she.
Right.
That's yeah, exactly. 6350. That's what they could
Yeah,
borrow.
and your credit availability is less, and then now the next year you pay it off, and then you just popped up your availability. So think of that cash value as your equity in your policy that you have access to,
That's a
right?
good way to think about it. It's equity, like your
Mhm.
home.
Yep. And so whenever you're taking money out of a policy, you have two options. You can either take it as a withdrawal, which means you have no intention of putting it back and you want to just permanently take it off the books because you don't want to get charged an interest rate. Or if you have intentions to put it back, then you would want to take it out as a loan so that you can do what my dad just illustrated here, is to be able to have that pop up the cash value back up again. So even though the premium that went into it was 203, I think that number says, you have cash value that increased that year by 212. So see that column next to the total cash value?
Yeah.
That's saying, hey, what did it do just that year? So it's going to pop that back up. So that 203, putting it in, turns into 212. Do you want to put that back and go from 203 to 212? All day long?
Mm-hmm.
Yeah, take a look at, you put this back, okay, and in 5 years, it more than doubles. It goes from 218 to 448 in 5 years.
Right. And that's always the case. And so you have the
But that's a lot of
compounding
money
now.
to double.
It is. And what happened is you because you were able to put it back into rotation, it allowed the compounding of that full thing to now be just compounding. Now, even if you had that loan that was outstanding, so everything that you're doing, everything is a trade-off. So whenever you make a financial decision, you're saying, what am I putting in and what am I getting out, right? So even on the question on, like, let's say that that person used that to pay off their house. Does that make sense to do? Well, maybe. It kind of depends, but let's say that that house payment on that 173,000, let's say that was their total balance that was left. What do you think that their total payment was that they were paying on that house overall? Maybe $20,000 a year, right? So basically, couldn't you do the same thing and say, okay, I'm gonna not pay off my house, and I'm gonna instead be socking that money away and letting that be compounding and growing, and then now I'm gonna turn that into cash flow. Now, wouldn't you want that cash flow then to offset and pay more than the $20,000 that you have on the house?
Yeah, that makes sense.
And would it do that? Yes.
Mm-hmm.
Okay, so there's sometimes it makes sense to pay things off and sometimes it doesn't. And so you want to be able to look at what's my trade-off? What am I putting in versus what am I getting in exchange? And so if you're trying to pay off the house because you're trying to get rid of $20,000 worth of payments, if that's your reason for trying to pay off the house, you may have shot yourself in the foot because you may have left the money there and given yourself $30,000 in income, but yet you wanted to save $20,000 a year in a payment to the house. Does that make sense? So you
And
want
you don't get the tax credit either. No tax.
exactly. Exactly. So there's just more to consider with this. So that's why we can go through this on strategy sessions. But the easiest way to look at your cash value is that that's your equity, that's your line of credit. So anytime that you have a loan against it, you want to have some sort of game plan to get that back in so that it can pop everything all back up again. Even if that game plan is to say, hey, when this person is 59 and a half, maybe they don't want to pay off the loan and they want to wait until they've got their 401k funds that they're needing to take out, and they're going to take the 401k and kind of slowly move that over into here and pay back the loan at that point. that's okay as long as there's some sort of game plan. I'm not saying the game plan needs to be that it's right away, but in the meantime, if you've got that outstanding loan and you're not paying any interest on it, not making any payments on it, and then you start to get in a tight spot and you can't even make the minimum payment, that's asking a lot of that one policy to handle on its own without you feeding it. You're asking it to pay the interest, you're asking it to continue to grow, and then you're not really feeding it. You're kind of having three things that are working against it. That's the part that you want to be careful with.
Now, Christy, you had mentioned something about if you don't intend to pay it back and then just take a withdrawal because you stop paying the interest on that loan. Does PEN limit the amount of times that you do that? Is there a limitation?
Yes. So you can only withdraw up to your basis. So let's say that you've collectively put into your policy $100,000 and you want to withdraw $110,000. You can't do that without it creating a modified endowment contract and making the whole thing now taxable from here moving forward. They will let you do it. You don't want to do it because then you now have a taxable contract that's no longer the tax-free benefit that you intended and wanted it to be.
So,
So you would want to withdraw up to your basis, but not anything more than that. So if you're considering a withdrawal, please don't do that without having us run an illustration for you. Or even if it's on a large transaction, let us go through that with you to just make sure that we're not going to jeopardize your policy in any way, shape, or form. So even though you can do it, we want to make sure that we're following those thresholds and the IRS guidelines when we do so.
Okay, I want to talk real quick, excuse me, Deanne, just a second. I want to talk real quickly about this loan balance of 173. I want to go classic IBC with you for a second. That $170,000 was a loan, was a debt that you had. And most people, if they don't have a policy, they're going to fret over this. The older you get, the more you don't want to be in debt. But classic IBC, haven't we turned this from a debt into an asset? Huh. What does the bank do all day long? They take your debts and turn them into their assets. We're doing the same thing. This debt that used to be a naughty thing is now an asset. And when I pay this back, the policy pops back up with tax-free dollars more than what I put in. So I've taken this, I've changed the direction, I've changed the course of the money from going away from you to going back into an account that you own and control. That's classic IBC. Any questions on that? Do you understand what I'm saying?
I do.
Oh, yeah.
So you should look, when you look at your policy, you should look at it and say, my policy is worth this, which is the loan balance, plus this.
Mm-hmm.
That's what it's worth to the banker.
Mm-hmm.
Okay, so that's what it is. And so when I pay that back, lo and behold, it does pop up even more than I put in. That's because I'm in the 7th year with this particular policy. Not
So
too shabby.
we've got
Go ahead.
about 15 minutes left, and I want to do some dashboard stuff, if that's okay, Dad.
Sure, go ahead.
One
Sorry.
thing, just before I forget. So generally speaking, on your policies, you will most likely want to do a loan while you're in your contribution phases of putting money in and premium paying phase. Okay. Now, every single one of you can put into your policy and pay premiums on your policy for 7 years is the minimum that you're going to want to at least put in the minimum and up to the maximum, anything in between those two for 7 years. Okay. After that, then you're going to decide how long you actually want to put into it. And so let's say that you are planning on retiring 7 years from now, and then you want to put into it for 7 years, and then now you're planning on taking money out, which, by the way, you can be contributing money in and taking money out at the same time too. So I don't want you to think that you have to do this for 7 years, then retire. If you were planning on retiring, there was a case that we worked with a guy yesterday. He's retiring a year from now. In his case, we're actually going to be taking out of taxable accounts to feed into the policy. And then he's going to be turning around and using the policy later on because he's trying to get out of his taxable accounts first. And we're actually going to get him down to a 10 and 12% tax bracket between now and age 100. He's going to end up paying less than $200,000 total in taxes that whole entire time between age 61 and 100. And he's going to be spending more than 5.6 million and still having about $1 million plus in just raw IRS.
Sign me up.
What he'll have in policies. Okay? That's why we do what we do, because it makes sense to have that money stretch further, pay less in taxes, and have more spendable to you and leave more to your heirs. Okay, that's the power of the policies. So when you talk about the policy loans and wanting to replenish it, don't misunderstand this as the most powerful asset that you have. Don't think that you're going to get more bang for your buck by paying off your house with that money from the policy rather than having it there to give you tax-free income, because you're missing the boat if that's the case. This is your most valuable asset, I promise. So just keep that in mind. Now, having said that, the only time that we usually will do withdrawals is when you're actually done funding it and now you're actually starting to take money out of the policy. That's usually when you don't care about trying to put the money back in, because you're now actually draining the account. You're kind of on the downslope of the mountain, as my dad says. You're on your way coming down the mountain. So you're not trying to fill it up. You're trying to just take it out, and you're strategically taking it out. That's usually when you're going to do a withdrawal, not necessarily in your contribution phase of accumulation phase. So, okay. This is Penn Mutual's dashboard. And again, it'll be similar to Guardian. If we've got a minute, and Adam, I might switch screens with you and let you show Guardian's dashboard if you're okay to do that. Okay, so Penn Mutual, this is what your dashboard looks like. This is one of my policies, and so it has several different things on here. So this policy I picked on purpose because it has several components. Everything with Penn Mutual is all in one place, and so you can see everything all in one area. Now, if you want to know the details of any particular section, this little eyeball icon will give you the details, and it'll give you a breakdown that's a little bit more thorough. So that's what these little eyeball icons are. So quick tour of this. Number one is that these boxes right here are cash value and death benefit. Now, the death benefit in me, these boxes, to me, these boxes are opposite. This is saying that in this particular policy, I have a net death benefit of 2.6 million. And then this is saying that 559,524 of this 2.6 is coming from the base part of the policy. Okay, so this is my actual cumulative total net death benefit. Now on these two boxes, these are opposite of these two boxes. This is saying that the guaranteed cash value amount, this is saying how much of my actual cash value is coming from the base part of my policy. So remember when I said that in this case, the base part of my policy yearly is 12,000. So I've had this policy I'm in my 4th year. And so I've got some cash value that's coming from that portion, but most of my cash value, as you can see, is coming from what I put in for paid up additions. Okay, so that's what I mean by you will have some cash value from your base, but this number will be less than this number. It doesn't mean that this is the only guaranteed amount. This is kind of poorly named. It just means this is how much of my cash value comes from my base part of my policy. Most of it's coming from somewhere else. And again, if you're not sure, then opening this up is easy to be able to see that. So I can see that if I died today, my beneficiaries would get 2.6 million. And again, this is that number we saw on the other page. We've got some of it that's coming from flexible protection rider, some of it's coming from paid up addition, some of it, if I actually died today, they would say, hey, this would be your dividends that were accumulated. Based on you dying today, your family would get this amount of dividend, kind of like prorated for the year is kind of the easiest way to say that. Now, if I died today, then I also prepaid some of my premium, which my family would also get back. And so that's why we've got this number here. Now, cash value, it's going to give us also a breakdown. It's going to say, okay, how much is coming from our base part of our policy and how much is coming from paid up additions. So if you're not putting anything in toward paid up addition and you're only doing the base part, you're going to be very slow in accumulating cash value. It will grow cash value, but not the same. So think of whatever you're putting in toward paid up addition as like the lighter fluid on your cash value. It's going to just accelerate it much, much faster. Now, if I wanted to cash out my policy and I said, hey, I'm done with this thing, then I also have prepaid some of my paid up addition. And so I'd get a refund. And so that's what that's reflecting. Okay. Now this will also be where you can see how much of a loan available you have. And so right now I have a loan availability of 265 on this. If I did have a loan against this policy, it would say loan interest, and it would have my daily loan interest amount right here, and it would have an amount here. And then it tells you what the interest rate is. If you ever want to generate your own contract, or not contract, but statement, like let's say that I want to use this as an asset. Let's say I want to go get a bank loan and I want to say, hey, you need 3 months of seasoning or proof of funds for, for the collateral. And I want to say that I have this is a private asset. So they're not going to know I have this unless I tell them and want to disclose it. But if I want to use this, then I can say, they'll usually say, oh, we need 2 statements. And I can go, okay, guess what? Let's see. I'm going to pick this date and I'm going to generate a statement on this date, and I can print the values up here and it will make a statement for you. So you can make your own statement anytime you want to. By the way, I do this once a year when I make a policy payment, premium payment, then I come in and I actually do my own annual kind of statement and just kind of generate that myself. You don't need to, I just like to, but it'll kind of give you all the information on it there. And then I can come back and go, okay, then I also want one for January 19th. And so you can pick whatever dates and it'll generate that statement. Okay. This is also where you can see like your premium and billing. So right now I have my base part of my premium or my minimum on an annual schedule. And so it's going to already have this in here. If you were on a monthly or a quarterly, it would have that monthly or quarterly amount and it'll say when it's next due. Now, when you go in on your annual, then it's basically going to say, okay, this is going to already be pre-populated for you. The part that's going to be flexible is your paid up edition. Now, if I click on this, it's going to say I can put in 2 cents because apparently I was 2 cents shy on what I put in. So dang it. I wonder if it'll even let me put in 2 cents. That's the funny thing. Okay, so it will say, it will have that base premium amount and then it will have this amount. Now, it might have this already filled in for you if it's kind of scheduled. You can zero it out and put in whatever number you want, and then that way it knows how much to take out depending on how much you're wanting to put here. But if it puts in 0 or if it puts in an amount, either way, that's where you have the ability to, on your dashboard, to just zero that out and put in whatever number you actually want to have drafted when you're doing your policy anniversary payment. You can save your information in here so that you can nickname it. So I could say, you know, personal checking account, you know, Wells Fargo, personal checking account, Chase Bank or whatever. So you can have it differentiate if you have different accounts that you might have it come from. So it'll save it. By the way, we never see that information and it won't ever even show your information to you, which is why mine isn't showing it to me. Your policy anniversary date, it'll tell you when you have your anniversary right here. Riders and benefits. This one is where you'll see when my dad referenced before, there's that paid up edition rider requirement for Penn Mutual. Now, Guardian is a little bit different. Depending on what year you got your policy, there's probably a scheduled paid up edition, which is going to keep the rider active, and most of it is probably unscheduled. And so it's probably like $100 or $250 for the scheduled part, and that keeps the paid up edition rider active automatically for you. With Penn Mutual, most likely, most of your policies, it's probably, you know, kind of considered scheduled. In other words, when you get your policy anniversary date paperwork, you're going to see that you have that option to pay it, but you can put in whatever amount you want to toward that. Now, my dad mentioned that minimum amount, so my amount that I can put in here, so it's scheduled for this to be $42,000. My rider requirement is exactly half of this amount, which means that every 5 years, if I haven't put in at least half of this amount, I mean, this is half in 1 year. If I haven't put in at least half of this amount in a 5-year time frame, then it's going to jeopardize me losing that ability to have that rider. Now, every time you put in $21,188, it's going to kick that can down the road 5 more years. So see how it says July 14th, 2030? That's because I've put in the full amount, and so it kicked it down for 5 more years. But if I get to January of 2029 and I haven't put anything in toward that, it will tell me right here the remaining amount that I need to put in order to keep that rider active. So it's obviously showing 0. But if you had an amount that you need to put in, so you'll want to pay attention to that part of it.
Christy?
Yeah.
Where do you see that date? Like to make like a date to make a final payment on your paid up edition to keep the same number?
It will be in here, like where in the dashboard? It will be right here under riders and benefits. You'll click on that little icon and it will be right here. So you'll see remaining amount to keep the rider active. You want to make sure that you put that amount in at least.
Excellent.
And it'll tell you the date that it's kind of set to expire, like to kind of keep that active. So you'll want to look at that date.
Thank you.
Yours is annual, so it says 0.
Like because I've put in the full amount. If I didn't put in the full amount every year, then then it would show an amount here. So if you are potentially in jeopardy, you will have an amount here. If you have no amount here, it's because you've put in at least the minimum amount, and so it'll tell you a date that it kicked the can down the road. It'll tell you when the 5 years was up. So I made my last payment July 14th, so it kicked it down the road 5 years from the date of that last payment. That's why that's there.
So yours says enhanced permanent paid up additions and mine says accelerate. Is that because I'm an old bat when I started mine? Is that why it is?
So there's two different paid up addition riders with Penn Mutual, and so sometimes one rider is better than another, and and depending on the time frame that you're planning on funding it, and depending on the age, usually depends on that rider that you have on yours. Yes.
Okay.
Yep.
Old bat. Yep. That's it.
No, I didn't say that. Okay. Now, really quick. So this is a catch up from the prior policy year. So apparently I could have put in 1 cent last year and I could have put in 1 cent this year. So that's why it's letting me put in 2 cents this year. Okay. So if you have a catch up, so let's say like, I don't even remember which policy I pulled up. I think this is one that I'm putting in 53,000 a year on, I think right around there, 55,000 maybe. Anyway, so let's say that last year I only put in 25,000 instead of the 55 that I could have put in, then it would show a catch-up amount right here. It would show me an amount. So if you do have an amount there, then that means that you can put in the full amount for this year, and then I can also put in the amount that I did not put in the prior year. Now that catch-up provision with Penn Mutual starts in year 3. And so if you're in year 2, you're not going to see a catch-up. If you didn't put in the full amount for year 1, I'm sorry, you can't go back and catch up year 1. But in year 2, if you put in a partial amount, then in year 3, you can catch up what you didn't put in year 2. So if you forgot and you missed the boat, it's okay. You can at least do the catch-up provision, but they'll only let you go back 1 year. Guardian, Mass, and the other carriers do not have that catch-up provision. So you won't see that on the Guardian or any of the other dashboards, but you would see that on your Penn Mutual one if you happen to be with Penn Mutual. So if there is an amount that I can put in, you're going to see that right there. That's where you find that. The other riders that you happen to have on here, it's just kind of helpful for you to know. All of you or majority of you should have like accelerated benefit riders, which is for chronic illness or terminal illness, which is the only circumstances you can accelerate some of your death benefit early is under those two circumstances. So you should see what riders are available to you on there. Any transactions that you do are all going to show up here. So dividends, by the way, you might see, 2 or 3 different dividends because you have 2 or 3 different components of your policy that are earning you dividends. And so you're going to have that show up on your policy anniversary date, like at the end of your policy year. On mine, this is an account that I prepaid into it. So see how it has a premium deposit fund? Some of you on here have this account. This is where I basically gave the insurance company money and had them hold it in kind of an escrow type of account that is earning taxable interest, okay? And at the time that I did this, it was earning 2%, which yes, I'm kicking myself now that I know that it's at 4.75 currently, but anyway. So I gave them, 500 and something thousand, and then said, hey, pre-fund this policy for me. And I can have it partially funded and I can have it fully funded. This one is actually fully funded, so I don't actually pay this one. This one is automated for me and it pays it for me on my policy anniversary date, which is why you see this that says discounted premium automatic payment. It actually is paying my base premium for me, and it's also paying my paid up addition for me. And because I missed when I did that, that's why it's off by 1 cent.
So a quick question here, Chrissy. So it's actually beneficial if you go ahead and pay your policy on an annual basis because you pay a little bit less, especially if you have a HELOC. If you have a HELOC, you let that money sitting there, just reducing interest.
Exactly.
And then you go and pay a little bit less on the end of the year.
Mm-hmm. Now, if you have a HELOC that you're paying it out of and you're maxed out on your HELOC, then I would never recommend to have you pay your policy and max out your HELOC. And so there's some of that balancing that, again, we'd want to kind of work through. But yes, generally speaking, a lot of people that have a HELOC, they would pay for this annually and then just have all of their income go into the HELOC to kind of pay out the balance and kind of bring that room again on the HELOC and then do rinse, recycle, and repeat because you are going to get more bang for your buck.
Jump in here for a second, Christy.
Mm-hmm.
Go back up to your anniversary date on there. Just scroll up. Notice the anniversary date is August 14th. Now go to your payments where you've made your recent transactions.
Mm-hmm.
I want to just show you something. Look, open that up if you would.
Yeah, I'm trying to have both of them on the same screen.
Okay. No, I mean I want to open that one up.
Oh, sorry. I
Because
see
I
what
want
you're
to show you something. Look at the effective date and the date processed. Isn't that interesting? You sent in exactly the same amount. I mean, exactly the same day. They were processed the same day on the 14th of each month.
Well, this is because it's scheduled through that automated system. And so the
Mhm.
system is doing it on my exact anniversary date. So it's putting in my base premium for me, and it's also putting in my paid up edition rider payment for me. And so my dividends are all on the same day. So this would be like last year. So I got like 1,600 from there to 321. So these are my dividends. So if I collectively added up these three dividends, that's my total dividend. And then it's also making my payment for me. Now, just so you guys know, while we're on that note, Dad, this date processed and effective date, if you come in and let's say let's say I was paying this and I didn't pay it until August 20th, it might have my process date of August 20th, but it would still have my effective date be August 14th.
Christy, it actually would hold on
Or
to
the
it
other way,
until
right?
September.
Yes.
Well, no, not when you first do it. So if
Oh,
you
you're talking the beginning of your anniversary.
Yes. Okay.
Yeah.
So, which is something I was going to say crucially. So, let's say you have your anniversary date on your policy. Let's say this is you. Okay. If you're like, okay, I don't have the funds yet, but I'm going to be getting a bonus check in a week. Should I come in and pay what I can pay now, and then a week later come in and pay the difference, or should I just come in a week later and pay the whole thing? Come in a week later and pay the whole thing, because whatever you put in, even if it's like a few days late, I'm in my grace period, and then anything that I put in is going to be effective as of my anniversary date. Okay.
Within the grace period.
Yes, only when you're in the grace period. Now, the only time you can do that is when you are at the start of your anniversary date. Okay. Now, after that, let's say that I put in, I think on this policy, I can put in 55-ish thousand. Okay. Let's say that I put in 20,000, on the 20th, and then they backdated it for me and made it effective as of the 14th. And then next month I come in and I put in another 20,000. Okay, this is something important to know. How does the company treat this money? When I put the money in, let's say I pay it on September 10th. Okay, there's something called a month anniversary. They're going to and that's what Shane was alluding to. Anything after my policy anniversary month, like in that first initial window, anytime that I make a payment toward my premium after that, they're going to apply it but they're going to kind of wait, and it'll kind of show it being processed, because they have to still put it in there on the effective date of your month anniversary, which in my case is the 14th of every single month.
They
Okay,
will hold it until the next 14th.
Correct.
so they'll give you credit for it, kind of like it will still reflect, but it will kind of effectively go in on the 14th on your month anniversary of whatever the 14th is coming up. So if you put it in, and I'm not saying hold on to it, it's not worth holding on to it and then trying to pay it right on the 14th. I'm just telling you that if you come in and you see a difference, or they say, sometimes it will have on your account right here, it'll say funds held or unapplied funds. If you ever see that, that's why. They're basically saying, hey, we're letting you know that we received it, but we can't really technically apply it and have it be earning dividend until the 14th on your month anniversary. But they want you to know that it's there and that they received it. And so if you ever see that, that's the reason.
And I do believe that Penn is the only one that does that. I think everybody else kind of applies it exactly when it comes in. But we're talking about pennies compared to everything else.
Now, so you have yours in an escrow account. Is it through the your automatic payment? Is it through your own bank, or is their bank?
No. This is through Penn Mutual. So I have a
Okay.
side account that's actually directly linked to my policy. The only purpose of that account is to feed this beast for
Right.
me.
Okay,
Yep.
but that was just the first part. So that when you so I was saying that out loud because I understood that. But
Yep.
so then if I were to make my automatic payment through my bank on my anniversary date, do you do it through Penn Mutual interface or your bank interface to make it an automatic payment on your anniversary? Like a bill payment?
You can actually
You would
do
do
either
it through your
one.
bank. You would do it through your bank. You actually wouldn't do it through here. You would do it through your bank. If you want to set it up that way, I would do it through your bank.
I think I
Yep.
will.
Yeah.
Just keep in mind though, Deanna, if you do it through your bank, it's probably going to take several days to have that done right. So if you're making a PUA payment halfway through your policy and you want to have it done on the 12th, I would aim a little bit earlier so that
Well,
all gets processed
Like
before
with
the
the mail
12th.
time and stuff like that, he's saying.
Yeah.
not due till July, I mean,
But if
June.
you're doing it,
To
you're
make
doing
it,
it annually.
yeah, you're telling me to, instead of like making the due, having them pay it on exactly June 5th when it is, you're telling me to have them schedule it like June 1st or something. Is that what you mean?
Correct.
Yeah.
Just have
Okay.
it done before.
Okay. All right.
Okay. Now, another thing I want to touch on really quickly, just so you all know. So on Penn Mutual, you have a section right here that says correspondence. And so if you click on this, you can all, and you should, do your policy illustration. So your original policy illustration, and so mine, I started this in 2021 on this particular one. And so if I click on this, I can actually see what my, I'm kind of curious on how much I was putting into this thing. I think it was 55. Anyway, so you can see all of your policy. Yeah, it is 55. Good. So you can see all of your policy pages. So when we were saying before that it'll be somewhere between like page like 9 and I know Deanna, you were thinking it was later. It's because I think you were looking at your entire policy packet, which is like 127 pages.
I was.
If
I
you're
didn't go
looking
there.
at this particular illustration, it should be within the first 17 to 20 pages and not necessarily that far out, but that one's fine too. But if you're ever wondering like, hey, where was I scheduled to be and where am I right now? I think you'll be pleasantly surprised. It's probably performing better unless you're taking loans out of it and you're having different multiple things or you haven't fully funded it, then it's not going to be reflective of that. It's not going to be easy to say like where was it supposed to be versus where is it? But that helps you to be able to know that that's in here. So I would print that off, but you also have a copy of it there.
But your illustration, it's not in real time. It's just what it was at the beginning, right?
Yeah, it's your original illustration. Yeah. Now, if you're wanting an updated illustration, once you've had your policy in place for a year, we can do what's called an in-force illustration, which means it'll take what has happened in the past and it'll let us sample whatever we want to in the future. So if you're like, hey, what if I only pay this much this year? What would that do to the rest of my policy years? And we can kind of actually sample that out and show you that illustration. We can run different scenarios, but we're not able to do that in-force illustration until your policy has been in effect for a year.
Okay.
Now, in my case, because I have that premium deposit fund, so anybody who does have a premium deposit fund, this is also where you're going to get your 1099 interest earned on that premium deposit fund. And so if I click on this, this will actually pull up my 1099. And so if you should receive it in the mail, but you also have an electronic copy here. And it'll also have, I mean, it'll always have the previous year on there if you happen to have that account. Now that account is something you can add to an existing policy. I happened to do this when I started this policy, but you can add that. So if you're ever looking for like a high yield account and place to put money and you want it to feed into your policy, you do have that as an option. So
But
I
you
know
still put the interest rate of what it was when you first opened it. It doesn't go up and down.
no, it's locked in. So when I started mine, it was at 2%. So mine is at 2% for the entire 10-year time frame that I signed up for. And right now it's at 4.75%. So if you started at one of those accounts right now, it would be 4.75% and it would lock it in. You can do a 2-year and all the way up to 10 years. So you can do whatever time frame you want to.
Okay.
So, okay. One other thing on here, it's not showing it here, but you have a little icon that's like a little pencil. You can actually change beneficiary straight here from the dashboard. And so you can do that if you want to. Here's also some common forms. So I'm going to touch on this really quickly on the two most common. So even though there's a beneficiary designation form, like I said, you can do that straight from your dashboard instead of doing this form. But if you'd prefer to do the form, then you can do that too. Loan request. If you're ever doing a loan request, this is a fixed product, not a variable product. And so you would do this loan request form fixed. If you needed to do an address change form or you needed to change the owner, like if you wanted to change it to a trust, then you can do that. Pen check plan. This is if you're wanting to switch this and do this on, like when I was saying before, like if you wanted to say, okay, I'm going to do a new plan and I want my base premium to be paid. Now here's a little trick with this, by the way. This is my own little rule of thumb. My policy anniversary you just saw was on the 14th. It needs to be paid before the 14th of every month. So I would pick the 8th as my draft date in an ideal world. And I would say, okay, I want you guys to draft my base premium. And I also want you guys to do my paid up edition. And I would put my policy number. I would put my base premium amount that it's going to draft. And I would put the paid up edition that I want them to draft. I would say I'm doing this from a checking account. I would fill this out. I would send this into the company, and then they would actually draft that payment for me. If you ever want to make a change to the way you have it drafted or the amount, then you would also do the same form and have them change the amount. So if I was like, hey, I want to do $1,000 a month toward paid up edition, and then I was like, oh, never mind, I don't want to do $1,000 a month anymore. I want to do 500 a month because things are tight. You can do the same form and make that change. We can walk you through doing a loan. So the first time that you do it, please let us know. There is an email on here that you can send this request to. So if you do request a loan, please also carbon copy us so that we have a copy of it, because the company has had fraud stuff, as any company has. And so a lot of times they're verifying that you're the one requesting the loan and that it wasn't fraud, or that somebody didn't like force you to take out a loan. And so they'll ask us to verify that. And if you send it to us, then we know that it was actually you sending it to us and them. And then we can verify that and have that go through faster for your policy loan.
I don't think I copied you on mine. Sorry.
Oh, that's okay. And if you don't, that's okay. But they probably will verify it with us. And so, you know, if you give us a heads up that, hey, just so you know, I requested a loan for this much, even if you forgot, then that helps that go through faster in case they need to verify that. Okay.
Question for you.
Yeah.
If you need to change from monthly premium payments to quarterly, does that have to be through a phone call? Or I know you said it has to be, you know, just before the anniversary date, but
Yeah, so you'll do it within 30 days of your anniversary date is when you'd want to make that change.
okay.
And so if you're going from more often to less often, like you mentioned, like if you want to go from monthly and you want to switch it to quarterly, they may actually let you do that partially through the year. They would not necessarily like the payment is the same if you're doing quarterly versus monthly essentially, and so it's the same. But if you wanted to change it and have it be less often, you could actually call them and have them make that change for you. If you're doing less often, then you wait for your policy anniversary. If you're doing it, I mean, I'm sorry, if you're doing it more often. In other words, if you're going from, actually that wouldn't make sense. Hang on. If you're on an annual right now and then you want to switch to monthly, then you'd wait till your anniversary date. If you're on monthly and you want to switch to, like, let's say you just got a big amount and now you want to do like an annual amount, you can do that before your anniversary, but you can't switch to monthly until your anniversary date. Does that make sense?
Yep. Mhm.
So, but yeah, you can make
Just
that
that
change.
form that you just used, again, it shows routing number and all that. You still suggest going through your bank. So, so I'll go through university. So then,
Well, no,
if,
this was if you're taking a loan from your policy.
oh yeah, okay. Okay,
Okay.
so
So
then,
yeah, and now here's two options, just so you know. When you take out a policy loan, you're going to either take out a policy loan and use this form. You can make a phone call if it's less than 50,000 and do it over the phone and say, hey, I want to take out a policy loan for X, Y, and Z. And you know, you can have them do that over the phone. If you do it that way, they're going to mail a check to you though. And so it's a little bit slower, and then you don't necessarily have a paper trail. If you want a paper trail and you want it electronically deposited into an account, then you would say, I elect to have this sent via electronic funds transfer. And then they're going to ask you for a copy of a voided check so that way they can deposit that into your account and do an ACH, which is a faster way to get the funds to you. Policy loans usually take somewhere between 3 and 5 business days on like normal everyday. It can take longer if it's like around Christmas time or it's in the middle of the summer. Sometimes it's like as long as 7 to 10 business days, just depending on, you know, because they tend to have more people on vacation at the home office, and then they also have more people requesting loans both. And so you can have a little bit longer time frame if it's around Christmas or around holidays or something like that, or summer break. So just keep that in mind that it can take a little bit. So you'll want to plan ahead that way.
so if I route the automatic payment plan, and I said it earlier, like June
Mm-hmm.
1st, and it's not due to the 5th,
Mm-hmm.
and it gets there early, then they're not going to apply the funds until the 5th, right?
Right. So you don't necessarily get any points for getting it to them early, but you'd want to get it to them by the, you know, by the due date. So if you've got a policy anniversary of the 5th, then I would say you'd want to have them receive it by the 5th. And then that way, even if it takes an extra day or two for them to apply it for some reason, they would still apply it as if it was applied on the 5th because it's at the very beginning of your year. So, yep.
Perfect.
So if you want to automate that, that would be great. If you can do that directly through your bank. So you can just do automatic bill pay.
Perfect.
Okay, you guys, hopefully this is helpful. Know that we can do illustrations. I'm going to kind of switch this back to an internal view. So anytime that you want to, we can do this running an in-force illustration and play out any scenario. So if you're wanting to know the cause and effect of a loan, or hey, should I pay back this loan or should I put it toward new premium, we can actually illustrate that and do that as a session, or we can just send the illustration to you, either one. So that way you can kind of see the cause and effect of what that looks like. But just know that even though the loan balance is outstanding, in an ideal world, even if you're not making any payments on it, in an ideal world, at least try to do the interest only on it. And so at the end of the year on your statement, it will show, hey, this is the interest that is accrued. If you do not pay that interest amount, then they're going to take it from the cash value. And so then you're basically asking the policy cash value to pay your interest for you, which is the same thing as like if you had a HELOC, right? So if you didn't pay the interest only, then your balance would accumulate. Again, it's the same thing with the policy. So if you're not putting in the interest only, then your loan balance is going to be accumulating faster because you're asking that policy to handle that for you. And so that's what we mean by just kind of being careful and just being an honest banker in that regard. So.
Okay, perfect. Thank
Okay.
you.
All right, you guys.
Go ahead, Christy.
Oh, nope. I was going to say we've got the poll up. So if you guys don't mind filling that out, that helps us know what to do for future times. And we'll have this so that if you want a copy of it, we can send it over to you. If you have any questions about your particular situation individually, let us know. But hopefully this was helpful.
Hey, Christy, this policy you have based on that amount of 200 and some thousand, okay?
Mm-hmm.
Now, that mechanism, is there a minimum amount that they would need to
Good
hold,
question.
okay, for you to be able to do that?
So yes, so if your policy, and by the way, Guardian has one of those as well, and it's a
Okay.
similar rate. So you can do
Okay.
that with Guardian, since I happen to know you have a Guardian policy. So they have it, they call it, instead of premium deposit fund, it's called a premium payment in advance fund. And same thing, same mechanism. Now the minimum is that if you want them to prepay that for you, it needs to at least cover your minimum payment on your policy for
Okay.
2 years.
For
And so
2
the
years.
minimum amount is dependent on your policy. So in my
Okay.
case, on this one that I was just showing you, it was 12,000 is
Okay.
my minimum. And so if I had at least $24,000, then I could have a discount by giving them the 24,000. They would have it earn 4.75%, and then at my policy anniversary date, they would pay this 12,000 for me, and then the rest would hold in the account and earn again. So you can have it cover your minimum amount or more, and for a minimum of 2 years. So that's the minimum amount for that premium deposit fund, is depending on the policy. Now, if you're starting a new policy, you can have it be based on that, and you can kind of make that fluid. But on an existing,
And now, when you say based on that, here's my other question. There's a minimum amount, and then there's a time period you would want to have it funded for minimally. But now, in this case, you have $260 some thousand. Okay, policies go for much longer. What is that amount has to diminish, right?
Right. So
Okay,
it's a sinking fund. So that 261 that's there, it
Yes.
accumulates some interest, and then on my anniversary date, it takes 55,000 and pays it into my policy for me.
Okay.
So what it's actually doing, you guys, this is fun, and maybe we should do a training call on this one sometime, just on the premium deposit fund, because that thing is so fun. I love it. I need to start another one actually at a higher rate now. Now that one, that policy, or this policy, I guess, that I have up on the screen. So on this one, it's funding it for 10 years. Now, after the 10 years is up, then I've now passed my 7-year window. So I have two choices when this fund is done, paying into my policy premium for me. Then I basically can say, okay, I want to fund it myself now, because my premium deposit fund funds have now all gone into my policy. I can still fund that one myself if I want to, or I can stop it and do what's called a reduced paid up, which says I'm no longer putting any new premiums into it, and just let it sit and bake and let it just keep accumulating. It will keep growing on its own past my 7-year mark. So yeah, so you can get a discounted premium for 2 years. You can fund it for 10 years, and it would need to be somewhere between your minimum and maximum. So
okay, no, this is great. So if you have, so you start with that initial amount, can you add more to that base amount? later?
No. So think
Okay.
of it like truly like an escrow account. And so
Okay.
it's not a fund that is intended for you to put money in and take money out of. They won't let you take in and put it out. So you're going to like your intention is to leave it with them and to leave it there. Now, I will say that in a worst case scenario, if I wanted to, I can close this account out, but then I can't ever start another one with this company because I burned that bridge because they're giving me
Right.
credit for this interest earned for the whole 10 years, even though because they're planning on having it earn. And so if I
Right.
take it out early, my penalty is not financial. My penalty is that I can never do one of these with them again because they gave me the benefit of that interest for the whole 10 years up front, and now I canceled it in year 4.
Now they're using that money to invest and pay other things off too. They're using your fund that you put in. They're counting on that asset. They're counting on that asset
Exactly.
as it's raining
They're
me.
just being bankers.
Yeah, they're just being their banker to,
Mhm.
to invest do other things with it. I
Right.
Well, the reason I asked about subsequent donations to, well, contributions to it is because there's certain real estate options when you sell a home.
Yes.
And a buyer can, in order to avoid overtaxing yourself on or paying too many taxes, they can pay, I forget the name of it. Is it a 1039? I'm not sure. But
1031.
What's that?
1031. Yep.
1031. Okay. So they make, payments in chunks or however that's done. Okay.
Right.
Update on that. So that's not something that could be incorporated into turning it into a policy then.
Oh, absolutely. That's actually where the funds came from. This was a real estate deal where it was 500,000 that got put into this premium deposit fund and got directed to pay $55,000 a year for me into a policy for 10 years. So for 500,000, I had 55,000 a year going in, which is 550,000. That 50,000 difference between what I put in and what it's putting into my policy was the interest that it's earning, by the way. And that's also the amount, that's the only portion that I'm taxed on is that interest earning. But where did that interest earn go? Into my policy that is now growing tax free. So that's why I love it.
Can you put in that premium deposit fund instructions for just to pay the paid up additions and let you pay the premium yourself? Oh, it's only okay.
No, it needs to at least pay the base. And then you would do the paid up addition. It can do some of or all of the paid up addition in addition to the base, but it can't cover part of the base. So if my base was, this 12,000, I can't put in 20,000 into that account because that 20,000 is not going to cover even my minimum. It has to cover at least the minimum.
Gotcha.
Well, a Friday session on this would be very helpful, certainly for me, because we're in, we're 72 and we're in the situation where we want to reduce. We have 2 homes. We want to get rid of one. We want to live, so we need to know what to do with this in order to help our current situation as well.
Yeah, and that's really what that premium deposit fund is intended to do. It's intended to handle lump sums. And so, like if you have a death benefit that comes your way, or you have a settlement of some kind that comes your way, you sell a business, you sell a property, it gives you a place to take those funds and to have those be applied into the policy at a discounted rate and have it be able to just have a place to go and have it earn guaranteed interest in the meantime. So the 4.75 that it is right now, if you started a contract, then it would lock it in for that 2-year to 10-year time frame, whichever one you ended up doing. And so it locks it in. Now, once that account is done, like let's say you did a 2-year, once that account is done and it's paid out, you can start a second premium deposit fund on that same policy, but you can't have more than one premium deposit fund per policy going at the same time. You also can't add extra funds to it. So if you, like in this case, let's say that I gave the premium deposit fund enough to get to pay $30,000 toward my policy for me, that means that I could also put in $25,000 a year myself. I can do it that way because it was more than the minimum. And so I can do that. So there's a lot of flexibility within that.
Real quickly, David, unfortunately, Guardian will not let you add this premium deposit fund
they
to
will.
an existing. No, they won't.
Okay.
Yes,
Well,
they
thank
will,
you,
Dad.
Jim. Okay.
No, they told me they wouldn't, Christy.
Yeah, I've done it before.
Okay, maybe they will. You got to talk to the.
They maybe didn't used to, but they do as of about 3 years ago.
Okay.
Competition, I guess, right? We'll have to see.
Right. Yeah. Yep.
I'll vote for a session like that, especially because I'm going to be doing this exactly in about 6 months or less. I vote for that.
Yep.
Okay.
Now
Thank
you
you,
can put it
guys.
on you can put it on an existing policy. You can also start a brand new policy with it, so you can do either or. Yep.
Thank you. Bye-bye, you
So-
guys. Have a good weekend.
A good one.
All right, you guys,
You
thank
guys.
you.
Kristen,
Oh,
real quick.
thank you.
Yeah.
So you're not saying you did a 1031 from the sale of the real estate into this policy, you sold the property and you move the proceeds into there. You still have the tax consequence of selling the property, but you've got that lump sum that you're using. Okay. Just want
Right.
to make
Yeah.
sure.
Yeah. I mean, your choices when you sell a property are either to do a 1031 and roll it into another property, which does not get rid of the tax, it just defers it, right?
Yeah.
Or you sell the property and you don't roll the funds and you pay the tax. So yeah, it was a property that sold and then taking the proceeds after tax and then putting it to use and having it go into the policy. Yep.
Okay.
Chrissy, my understanding is that a 1031 reduces the total tax paid on the transaction?
No.
No? Okay.
What it does is defer the taxes and defer the tax computation. So what you're saying is, it's like a 401k. You're just kicking the can down the road. What's the taxes going to be when you take it out?
Yeah.
Well, many people don't ever take it out, David. So it stays in the family, and then the family inherits the house, and then they have to sell it.
Right.
A 1031 is one of those things that everybody thinks is a great idea in the real estate world until you really start looking at the numbers. And
Right.
sometimes it is, but it's not the be all and the do all and be all that many people think it is. Because you'll eventually have to pay the taxes. Why not pay them now while they're on sale?
Right. Especially now.
Yeah.
Mhm.
Oh, thank you. Good, Joe.
Okay.
Yeah. Thanks.
All right. Well, thank you guys. We'll see you next week. Next week is a beginning session. So if you've got beginning questions, or if you know people who you think would enjoy being there, please invite them because it's open to anybody that wants to come. So
Okay.
with that, we're gonna start clearing the deck, and so we'll see you next week. Have a great April. Well, I guess it's not April, it's March. It's
Have
winter.
March 1st.
Mhm.
March 1st.
Yeah. You too, Joe.
Yeah,
Bye,
my-
Christy.
all right.
And then a good
Bye.
April.
Yeah, then
He's
we'll
been
do
in the
April after
in the Highlands too long.
Mhm.